You don't fight the taping. You don't fight the Fed. You don't fight the central banks. We're still in a secular bull market. The risk is that indicators that we often see at the end of a bull market have started to look a little bit more dangerous. The earnings yield on the tech sector, it's at the lowest levels we've ever seen. And so is from a global perspective, the U.S., thanks a lot to its tech, the weight of the tech sector is far and away is the most expensive region in the world. The growth value ratio is a good indicator for the Oil Country World Index. And you're basically comparing, the weight of tech and other sectors relative to the weight of financials, industrials, and other sectors that are heavy in the value. And so there is a tendency when the market gets on the defensive, you're going to get that rotation in those areas which are better valued.
Hi, Tim. Thank you very much for joining us and welcome to Excess Returns.
Thank you, Justin. Glad to be here.
Matt and I are really looking forward to the conversation with you today. You've been at Ned Davis Research for a number of decades now, and you serve as Chief Global Investment Strategist, where you are responsible for assessing markets and asset classes, analyzing big picture stuff, but also looking at sort of the technical and fundamental indicators that you guys track and look at day to day. I was thinking about the conversation we're going to have today, and Matt, I know you know this as guys that are like research junkies. You always see these like cool Ned Davis like charts and data sort of coming out and being shared on social or maybe even in financial publications to some extent. And that's usually reserved for like the institutional clients. So when you see that stuff, you're kind of like, oh, that's cool because I don't have access to it and many people don't. But the research and the data is always super impressive. And what's cool about today is like better than any chart, we have you on to sort of talk through the process and the perspective that, you guys go through. So in some ways it's going to be better than probably any chart we can ever have. So with that, you can learn more about Ned Davis and their research and insights at ndr.com. So go there if you're interested in seeing what they're putting out and what they're publishing. So I want to start with you, Tim, on your sort of the overall higher level investment process that Ned Davis is known for. And I wanted to ask you about this 360-degree research process and first sort of allow you to talk about what that actually is and what are the key indicators that you're looking at in that model.
Well, I think the key point of how we approach the markets is to try to really be as objective as we can. And over the years, we built a database really to understand the relationships between data and markets. And then once we do that, we can build indicators that determine at what level does a particular data development have an impact on whatever market it is we're looking at. And then we combine these reliable indicators into models, composite models, which are equal weighted. There's a diversity of indicators. So it's essentially a weight of the evidence approach. And if we can build good, reliable indicators and put them into composite models that give us good information, then we follow these models and it will keep us on the right side of the major moves. And so the way we look at it, we call it 360 because it's certainly based on the price action of the market as well as the sentiment. We want to understand if a move has gone too far, maybe it's vulnerable to reversing, either coming down or going up, and that's sort of half of the challenge is understanding what the market actually is doing, and then the overlay to that, sort of to complete that 360, is what the market should be doing based on the macro conditions and based on fundamental factors like valuations, earnings, and things that are not purely price-based. So we put those two together, and oftentimes we'll find that the price-based factors will lead the non-price factors, and it helps us understand why the market's doing what it's doing. And so I would say it's really, we often say it's objective, it's disciplined approach because, things will change unexpectedly, but we want to make sure we respond to that. So it's disciplined, objective, and that keeps us flexible. And it's a risk-averse approach because we're always at least half of the weight is on what the market's actually doing. And that's that bottom half of that sort of 360 approach. So we're never going to be on the wrong side of major moves. So we're not going to try to catch the exact top or bottom. We don't think anybody can do that reliably, but we will, from an asset allocation standpoint, we want to make sure that we're properly exposed to the market when it's going higher, or defensive when it's moving lower. So that's pretty much the approach.
What are within each of those sort of buckets, so the macro and the sentiment, and then underneath the fundamental and the technical, like, could you just share like one or two indicators in each? You mentioned valuation, so that would be something in the fundamental bucket, I'm assuming. But in those, like, what are some of the indicators that you guys are looking at? The ones that maybe are have the most amount of signal, if you're able to share.
I'd say a common indicator that we have on the price-based side are indicators based on market breadth. And we want to understand how much participation is there. Is it just is it just like Oracle running things like it has today, or
Today?
broad-based participation? We have all kinds of stocks in different sectors and different regions of the world participating in the move. Is it a healthy breadth move, or is it very narrow and potentially relying on just one area? So I'd say, that, and then sentiment are things like advisory service sentiment. We look at put call ratios, futures trader sentiment to kind of tell us if what's the consensus. Is it a crowded trade? Is it perhaps everybody's piling in on one side of the market? We might want to think, things have gone too far. In fact, the way we use sentiment, we wait till it goes to an extreme and then reverses, because that's a sign, well, now you've sort of priced in all the news, either all the good news or all the bad news, and now the market started moving the other direction on the realization maybe things aren't as good or bad as the sentiment had indicated. And then on the macro side, a lot of indicators based on interest rates, bond yields, earnings growth, just a variety of things that we incorporate into our models to help us understand if it's a healthy environment or one that maybe would be prone to having the market get into trouble. So those are a few examples of, I think, what our indicators look like.
Okay. One thing that's pretty neat about this, and you can kind of correct me if I'm wrong about this, but I mean, because this model has been in place for a while, there's obviously a very deep, robust, out of sample, real time, real live model, not track record necessarily, but you have like numbers behind when this model is flashing, different things. So, I mean, because you've been doing this since like the I don't know if this specific model has been in place since the firm's beginning, but obviously it's been here for a while. So you have like this very rich amount of historical performance data that you probably are able to turn back to and say, like, how is this model done?
Yeah, I should explain. What I was describing is really sort of the modeling process, and we have a number of different models. We have models that cover, address different things, sectors, the economy, inflation, bonds, and what my major focus and a model I use is a global balanced account model, which answers the question, how do you want to be allocated across stocks, bonds, and cash? And we do have a real-time record of this going back, for example, fortunately in 2007, 2008, we were defensive and as defensive as we could be. And then, and we use the model to drive our asset allocation. So the model will sort of be that starting point, and then we'll overlay other things and maybe not move as often as the model would recommend, but we want that to be the starting point because that's the objective evidence. So then, in 2009, we went overweight, and, more recently we went overweight at the end of 2022, and we have a maximum overweight, 70%. We stayed there for 2 years. And then finally this year we've cut back the market weight, which is where we are right now. So that's kind of how we use the models to guide our recommendations.
And that might play into, I know you have a webinar, I think it's this week, where the title of it is Secular Bull Market Intact, but Secular Bear Risk Rising. So to your point, the model's sort of signaling some possible warning signs here?
Well, the model right now, and again, these models are really designed to pick up those cyclical trends. For example, we've been in a cyclical bull market since October of 2022, and the model has kept us aligned with that. And then we started to saw some deterioration earlier this year, and then we cut back, and then we got back in, but not beyond market weight. So that's kind of the cyclical approach. But when we talk about secular trends, we're talking about trends that can go on, 10, 15, 20 years. And put that in perspective, we've been in a cyclical bull market since 2022, been in a secular bull market since 2009. And the point of the webinar is going to point out that, right now, all the kinds of indicators, in fact, we have another thing we do, and as we approach indicators, to develop what we call watch reports. So we have a number of indicators, and more of them to kind of line up. They start to try to address a certain question. The question that report addresses is, are we going into a secular bear? And right now, the indicators based on price, such as the year-to-year change of the Dow Industrials, the Dow Industrials, number of record highs, all of these are not consistent with the secular bear. So it's saying we're still in a secular bull market. The risk is that indicators that we often see at the end of a bull market have started to look a little bit more dangerous, such as the fact that the dividend yield is as lowest it's been, is close to the lowest levels we've ever seen. Things like the market cap to gross domestic income ratio, which is the fact that household, allocation to equities, 2/3 of allocation, if you include pension funds, is in equities. And so it's just we're seeing these things, a very mature bull market. Doesn't mean it has to end right away, but the first question will be, are we going into a cyclical bear market? We don't have evidence of that yet. And then once that happens, we're going to watch that cyclical bear and just understand the environment we're in and also how bad that cyclical bear is. For example, the 07-09 decline in the market, more than 50%, was part of the global financial crisis. That was part of a whole deleveraging process that started in 2000. It was a very negative macro environment that required this massive policy response in late 2008, early 2009 to kind of turn around the global economy. And that succeeded, and that started the secular bull, which went from a sort of a deflationary environment back into what has been a reflationary environment. And we had a risk, back in 2022, the risk was we were moving from reflation to inflation. Well, as it turned out to be temporary, it turned to be sort of transitory, as that word was used a lot at the time by Powell and others, and it turned out it was more about the supply disruptions and the commodity prices. And finally, inflation came back down, the Fed could go on hold, and markets started to anticipate rate cuts. And it turned out that was all really a cyclical bear. 2022 was a cyclical bear than this ongoing secular bull.
So would a secular bear market be something like 2000 to the end of 08? Is that, or I'm trying to just what periods would define, in history at least, obviously the Great Depression, but maybe we can just skip that. But what would, in our lifetimes have been a secular bear?
Well, yeah, so 29-42, as you mentioned, that was one. Then it was 66 to 82. Okay. And 66 to 82 started with that Nifty 50 era, and it was really driven by this, the fact that we were in a runaway inflationary environment where wage price spiral was, continuing until finally the Volcker Fed broke the back of inflation with double-digit rates in the early 1980s. So in 82 was sort of the beginning of a secular bull that continued all the way into 2000, and a lot of the excesses we've started to see now became evident in the late 1990s. The market just got very, also got very complacent, and then we had the whole bubble of 2000 happen, the dot-com bubble, and so that was the next secular bear. So we had the secular bear from 66 to 82, and then 2000 to 2009. Actually, the bottom, was in early 2009. And, since then we've been in a secular bull. So there's really been, in our lifetimes, two that we can go back and analyze. And the first was really driven more by inflation, and the second more by deleverage and deflationary pressures. So it was a different macro environment, but one that was ultimately, in both cases, negative for long-term stock market performance.
How does the Federal Reserve policy sort of come into this? I'm wondering, you have probably rates, looks like, the Fed's going to be lowering rates soon, most likely. So how does that sort of play into this, this overall model and overall thesis, would you say?
Well, there's the overall, the one of the tenets we've always used is the tenet, you don't fight the tape, which means you go with the price of the market, and you don't fight the Fed, you don't fight the central banks, you don't fight the U.S. Fed, you don't fight Feds globally. And what we find is the indicators, you're going to be more likely, you're going to be more challenged if you're in a tightening cycle, which was the case, which was the big problem in 2022, is that we were in a tightening cycle. So when we get these thrust signals, these breadth thrust signals, which is really when you get these momentum surges in the market, there's a less of a chance they're going to actually be followed by sustained performance if you're in a tightening cycle, because that's a major headwind to the market. Whereas if you're in an easing cycle and you get those kinds of signals, you tend to get a more sustainable rally in the market going forward. So, we'll see what happens here. Of course, the Fed easing is one indicator of many, but it does help with the prospects that the market can keep going.
And just describe that thrust signal a little bit more. Like, what are you looking at? Would that be like a 90% plus up day? Would it be different breast signals? Like, just for our audience, if you could kind of shake that out a little bit.
Yeah, that's exactly the kind of indicator that we talk about. One of the indicators, and I have a report, I call it the Rally Watch report, and 5 of the indicators in there are based on thrusts. And it's things like 10-day advancing volume over total volume, and you want to see at least 2/3 of that on the upside. Things like percentage of stocks above their 10-day moving averages. Also, we want to look for global confirmation, 10% of markets above their moving average, percentage of stocks in markets at 30-day new highs. So these are the kind of indicators that are based on short-term time frames, and what happens, you tend to be at a negative market, and then it tells you really your rates of change can move pretty decisively in the other direction. So especially if you've already had a lot of pessimism, a lot of negatives are priced into the market, and you see that kind of turnaround, this breadth thrust, it's often the sign now you started to move into a more sustainable recovery. So that's how we watch for these to be sort of the first thing that would really confirm that the outlook is improving in the market.
That's always the trick, right? It's like, even in some of these really big down markets, you get some of those really powerful days, but trying to figure out, is that a sustained move, or is that just like I don't know, what do they call it? Dead cat bounce or bear market bounce or something like that, So like distinguishing between those can be tricky.
Yeah. I mean, there is a trade-off, because you want to get the early stages, but you don't want to catch just a 1 or 2 day snapback rally, or like you said, a dead cat bounce. So that's why a lot of the indicators I've found useful are ones based on like 10 days. So it gives you a little bit more time, see if you've got something going over a 2-week basis, and it's not just a quick bear market rebound, but something that's going to last longer. And then what I do is I look for, and actually the way this Rally Watch report works, so I have 16 indicators, and the first indicators are based on sentiment. So step 1 is you look for, when you're in a market decline, look for signs of excessive pessimism. And then those indicators will go on signals once you start to see the sentiment turn positive. That's the first thing we want to see, is the sentiment extreme. A lot of bad news is priced in. The market's kind of set up, is susceptible to a positive surprise. Then what happens is you get the thrust signal when actually people realize, well, things aren't that bad, and they start to buy the market, and it has some sustainability to it, and you get some good momentum going over, say, a 10-day basis. And then, that gets you sort of about halfway into the outlook improving. But really what you want to see after that are indicators based on 50 days and 200 days to confirm, well, actually, this is getting longer-term confirmation. Most markets are above their 50-day moving averages or their 200-day moving averages. And then the picture starts to look very good. And that's what actually helped us a lot in late 2022 when we started to see the thrust followed by that longer-term confirmation, and also following that sentiment extreme. And then what we do is we go and look back to the model I talked about earlier. What is the model telling us? And then the model agreed. So I think a lot of our approach is all about confirmation, and you want to see the more confirmation you have, really the more conviction you can have, and then the more decisive you can be in changing your position or changing your allocation. So that's kind of the approach to it.
Let's jump over to our friend, the bond market. Friend or foe? Well, let's start with this. Is it influencing your outlook for equities? How do you think about fixed income?
Well, right now, right now I think it's favorable. It's one of those developments where let's just again, I like going back to 2022 because it kind of puts into context where we are today. And we had been in part of the supporting influence for this whole secular bull market has been this long downtrend in bond yields, and we get down to multi-year lows in bond yields, and then along comes inflationary pressures and central bank hostility and worries about inflation expectations. So then bond yields start moving up very decisively. And this was happening at a time when there had been a positive correlation between bond yields and stock prices. In other words, the tendency had been when bond yields are going up, it's more likely to sign that the economy is strong. We haven't had any significant inflationary pressures for so long. But in 2022, inflation came back into the picture. So what happened? Bond yields started rising. The stock market really was negatively impacted by the inflation worry. Then the correlation inverted for the first time. We hadn't seen that since way back when bond yields were above 5%, and especially back in that inflationary period of the 70s and 80s. So what happened since then, as soon as we get to 2022, late 2022, when the inflation risk started to subside and the expectations were the central banks were going to be able to go on hold and start cutting rates, well, this calmed down the bond market. Bond yields then moved into a trading range. And the fact that bond yields moved into a trading range sort of removed that threat that equities had been feeling. And so from that point on, the stock market kept going. And actually the correlation then moved back to positive. And that's where we are today. And we're sort of in that range between 4 and 5%. And I think this becomes a good indicator to watch because we sort of always ask the question, what should get the market upset? What could get the market in trouble? Well, I think one could be a breakout above 5.25 on the 10-year Treasury yield, and then you get follow through on that. We did have a scare in the fourth quarter of 2023 or third quarter going into the fourth quarter, and then yields, it was really about that supply worry, and then yields came down again, and that got the market going again on the upside. So, yeah, yields are going to be important, and it'll also tell us something about whether or not we're moving into an inflation or, in the worst case, a stagflationary environment. That would be negative for equities.
So what about just walk me the way you would think through anticipated Fed cuts and then how you position duration around that here in September of 2025?
Well, that's always the question, is whether the market is, again, that gets back to the sentiment. Is the market overly optimistic about this? And then we look at our sentiment indicators and say, well, there's too much optimism here. And you're sort of pricing in a cut that maybe the macro factors don't pick up. And I think on the duration question, the way I approach that is through the asset allocation that, in fact, it was interesting in 2022 when yields were rising so much. That's the first time we had for most of that year, we were overweight cash. So that was telling you, when you're in a rising yield environment, you're losing money. And especially when the yields are inverted, when you're having that correlation between bond yields and stock prices turn negative again, that means that stock markets, when yields are going up, you're losing money in stocks, you're losing money in bonds. The only place to go to protect capital is into cash. And so cash was king for a while. And then things kind of, as the yield sort of stabilized again, it shifted. So that's where right now we're market weight, stock, bonds, and cash. So we'll see kind of how things break over the next month.
Well, let's jump to the market weighted or market cap weighted stock problem. You were writing about concentration risk in global equities not long ago, and the concentration of the top 10 mega stocks in the ACWI, which is interesting to look here, and how it had reached record levels last year, but it's started to decline since. How do you look at this declining concentration?
Yeah, well, there's really two possible implications. One is in like 2020, late 2020, we had a similar, not as much concentration, but we did have a concentrated market. And what happened after that was kind of this return to sort of a broadening out of the market and economic conditions improving globally and earnings growth started to come through. And then what happened is things did broaden out and concentration receded. Two other times, the implications were not positive. One was 2000, the market got very concentrated during the bubble of 2000. And then it was that, there's there's similarities there. And then it was again also about tech. It was about U.S. tech stocks in particular. It was that .com bubble. It wasn't AI, but it was a different influence. And then that sort of led that whole bear market. The other one, not to as such an extreme, to such an extreme extent, but 2021, the market got concentrated again. And going into 2022, again, it was those big tech stocks that started the market lower. And again, this was triggered by the rising bond yields I was talking about earlier, and the fact the inflation and the economic outlook worsening. A number of factors together were sort of, those big stocks and drag down the major benchmarks, and people see the benchmarks going down. And if you've got a lot of sentiment, you've got a lot of optimism in the market, then it becomes sort of a realization, things aren't as good as we thought, and it's time to reduce our exposure and move into other areas like cash. So where we are today, what I've been focusing on the fact that it has started to turn down. Now, maybe that was just a temporary rotation and we go back into the big stocks, which means maybe the bigger problem is going to be later on. Well, I don't think we have enough evidence to say actually the concentration is collapsing yet. But if it does, what we'll start to see is we're going to see the tech sector come down. And the fact that those top 10 stocks are mostly tech stocks or tech-related stocks, almost all except for TSMC are U.S. stocks. So you're going to start to see the major benchmarks drag down. The tech sector is going to get dragged down. The U.S. is going to drag down the benchmarks, and then sentiment's going to start to turn more negative, and then you have the makings of a bear market. So that's why I think concentration is a risk. And the question is, do we really have the kind of economic outlook to support a broadening out, which would be that situation we had in late 2020? So that's why I think we need to be paying attention to this.
It also feels like from your work, there's a connection. I'm drawing this connection. You're not necessarily drawing it. You can draw it if you want with the Sharpie. Between sentiment and valuation here, specific to tech. Earnings yields, talk through how you're seeing that.
Well, absolutely. I mean, valuation we've always say that, valuation is essentially a long-term sentiment indicator because to allow the valuations to get to those levels, then the market is becoming complacent about the ability of these stocks to deliver earnings, and that it suggests, well, now, we can buy stocks at this expensive level because we'll be rewarded for it because the earnings are going to keep coming through and things are going to get continue in this direction. And, so what we see right now actually is a tech sector. If you look at the earnings yield on the tech sector, it's at the lowest levels we've ever seen. And so is from global perspective, the U.S., thanks a lot to its tech, the weight of the tech sector is the most by far and away is the most expensive region in the world. So, and then the benchmarks that are weighted, like the All Country World Index by the U.S., are also looking more expensive. So it does, again, it's similar to that concentration risk, is that if people start thinking that for whatever reason the those valuations aren't justified, then you see a reversal in sentiment, say, well, now the earnings aren't going to come through like we thought, and that's going to start, drive selling of those stocks, and it's going to, create a downward pressure on the broad market. So yeah, I think that's right.
Within the downward pressure, I'm not asking you to throw a bone for the masochists in the audience, but this is for them. Value stocks, small caps, did they get any love historically when that broadens back out? Or if tech starts to take a hit, if the biggest stocks take a hit, is that really a bad sign for everything if that should start to develop now?
No, I mean, I think about, I remember in 2000 when it was a similar situation when, it was the tech stocks, and, it was really a tech bubble, growth stocks, and value was extremely cheap. Nobody wanted to talk about value stocks. And it turned out that was an excellent buying opportunity for value stocks. So within these secular trends, they really tend to be more about the large cap growth stocks, tech stocks, those areas that are driving these benchmarks that have so much weight. But yeah, there are opportunities, especially in value stocks and other sectors. Financials are the biggest sector in the Acme Value Index. In fact, I have an indicator that I showed recently where the growth value ratio is a good indicator for the All Country World Index. And you're basically comparing, the weight of tech and to, tech and other sectors relative to the weight of financials, industrials, and other sectors that are heavy in the value. And so there is a tendency when the market gets on the defensive, you're going to get that rotation in those areas which are better valued. And I just make the same point about emerging markets. And this is one thing we started to see. And again, I think it's too early, but emerging markets have started to come back to life. And the fact that what tends to happen after underperforming for so long, and nobody wanted to invest in China for so long, and was being considered uninvestable. Well, China started to come back and perform much better. And there's actually in China, and the reason I say China is important is that it has more than a third of the weight in the ACWI Emerging Market Index, MSCI Emerging Market Index. And so, this is one of the indicators in this secular bear watch report, where I have all these indicators that would tell us, what are the consistencies of what we see in the secular bear. Well, one is emerging market outperformance. We would start to see tech underperformance. You'd see defensive sectors like utilities outperform. You'd see energy outperform. So we start to get a picture of a market that's getting out of this expensive area and going into these areas that are perceived as better opportunities for valuation reasons, or maybe not as exposed to what is really, getting the market in trouble. And so this reallocation drives a sort of shift in the liquidity into the areas that have been neglected for so long. The same thing like with commodities and other areas. So,
do you think about it much at the allocation level for international, quote unquote, emerging, and what that means now? Are you allocating directly there?
Well, we have a 7-way framework. Basically what we do is took the 7 biggest regions, which includes the biggest markets like the US, Japan, UK, Canada, and then 3 regions, which would be Europe, Pacific, and EM. And we allocate around that. And so, to kind of apply that to what I was talking about earlier, is we had been overweight the US for most of the last couple of years. And then when we cut our overall equity allocation, we cut our US allocation. And we actually went to underweight, and we've actually moved back to market weight. But the point is, what we'll see over the longer term, I would expect to see, in fact, we're also market weight emerging markets. I said a lot of things right now are kind of in transition or potentially pausing, or maybe they'll reassert themselves. A lot of kind of mixed messages right now. But I think if we're going into a secular bear market, be a much better opportunity for emerging markets, and U.S. would be likely to underperform as the U.S. drags down the global trend. So, we're always. Really helps to look at things globally, because you want to look for global participation either on the upside or the downside. And that was an issue earlier this year because we had a very divergent market. The U.S. started to underperform, and that was a warning, but outside of the U.S., markets were holding up pretty well. Then finally we get into April and the Liberation Day, and then everything kind of collapsed at the same time. So those are all we always want to pay attention to. Markets globally.
Outside of that specifically, I want to talk about gold a little bit. You've had some interesting things to say about this. Gold's been a standout performer, maybe surprising to some, not surprising to others this year so far. We've got new highs. What do you think is causing gold to surge forward?
Well, this is the one trend. When you look at trends, and we've been bullish on gold since 2023, and the point is, it's been in a long-term uptrend. A lot of other trends have been, they've been choppy, or they haven't been very decisive, and equities have been kind of back and forth this year, and that's not really clear. Gold has maintained this long-term uptrend, and the only thing that happened earlier this year is when people started to realize gold was actually an outperformer. The sentiment, we have sentiment indicators on all these things, and the sentiment on gold got optimistic, and as a result, it entered a consolidation phase. In other words, it started to go sideways for a few months. But what was interesting about that is that going sideways instead of going up created a lot of pessimism on gold. I mean, that's not usually, if you're going to get pessimism, a market is going down. So from that pessimism, you had to set up for gold to really reestablish itself and break out, which it has done. And actually year to date, if you look at the different markets, gold far and away is up more than 30% this year. The best performing equity benchmarks are maybe 10% or so. So it really has been the standout performer, and people realize, well, gold's going to keep doing well as long as bond yields remain under control, and you have this sort of risk premium, a lot of uncertainty about what's going on globally. And the dollar weakness has been another plus for gold. I think it's I think it's in pretty good shape right now. And I have a same kind of report as I have for equity. It's called a Gold Watch report, and that report's been very useful. It's told us basically that the trend has remained strong, that the dollar weakness has been positive, and real interest rates, which is a key point, because back in the 70s, when we had those high bond yields, we also had so much inflation that real interest rates were negative, and that's what really helped gold. And you have sort of this whole risk premium over the market, the uncertainty about policy and a lot of global concerns. And then you have that fundamental support from the central banks that continue to buy gold. So it's a very good supply and demand balance. So it's just a lot of positives, and for whatever allocation you would have to it, I think you probably want to have as much as you ever would. It tends to be relatively small in your asset allocation, but certainly, I don't see any signs yet that gold's really running into significant trouble.
Does that make it feel like gold's in a long-term secular bull market here? Can we use those words?
Yeah, it is actually. And I have a chart actually when we analyze all these things from a secular standpoint, and gold's been in a very long secular bull, but it's also in a very strong cyclical bull. So, in order to get a secular bear, you have to have a cyclical bear. In other words, you can't have a secular bear starting without a cyclical bear. So both would have to have tops, and we're not seeing any signs of that yet with gold. So I think it's much further to go from here.
Let's talk a little bit more about just some of the other tools that you're using inside of this too. So as you're doing this cross-market analysis and you're thinking about the mix of all these, like gold in the asset allocation, how does that fit into a broader asset allocation puzzle here? We've been asked that question. I mean, the way we've always done our asset allocation is because we stay with the major asset classes that most of our clients are assessing, which is stocks versus bonds versus cash. Our benchmark allocation is 55 stocks, 35 bonds, and 10% cash. But, I would say if you put, like, say, maybe 7%, if that would be your maximum on gold, you would probably want to be there. And, where do you take it from? Well, if bonds, especially with the Fed cutting rates, then, maybe you want to take it out of cash. So then the bond cash question comes into play. But, gold's always a relative, it's not as big. We're never going to say we'll be 90% gold. I mean, that's not realistic, but certainly I would have as much as you ever would have. Internationally, do we worry at all about, we talked about growth stock concentration. Do we worry at all about financials concentration in value stocks, or financials concentration in the rest of the world and some of those cap-weighted indices, or any other sector concentrations?
Yeah, I wouldn't say financials. I mean, given how poorly they've done for so long, and the fact that the valuations are, been the cheapest sector for so long, I don't think that's really a threat. I mean, we're not, if we were moving into if there were signs that, we really have a financial crisis brewing, then maybe, that would be a concern, but we're not seeing that. So, no, I wouldn't say that's significant. In terms of concentration in other areas, really, you have to go to really find concentration. You really have to stay with tech. I mean, there are tech, what I say is it depends how they're classified. I mean, there are tech stocks, consumer discretionary, communication services. In fact, those three sectors account for those top 10. But the point is they're all kind of tech related. They're the same kind of companies that we're talking about there. But I wouldn't say any other sector is obviously dominated by a particular group of stocks at this point.
I'll tell you one thing, going back to gold for a second, it's definitely helping power the permanent portfolio this year, which is the permanent portfolio, Harry Brown's, which is 25% gold, 25% short-term bonds, 25% long-term bonds, and 25% equities. Gold is certainly helping. It's supposed to be like a all-weather type sort of portfolio. Anyways, just a comment on that. So I have, this might be a tough one. This is like asking, so I have like 2 kids, of course, no one's ever going to ask you like what kid you love more, but I'm just curious, like for indicators that you look at, are there any that are almost like your favorite, or maybe favorite might not, I mean, maybe most accurate in terms of what, things that you're looking at? Like any of the indicators that, like you talked about the 10-day breath, like anything really jump out that, like, either when it happens, like there's a very high degree of accuracy, or just in your experience, you see a very strong signal when this emerges? I mean, I know you're looking at like hundreds of these things, so it might be a little bit unfair of a question, but I'm just wondering if anything jumps out to you.
Yeah, I mean, I think again that would be when I get a signal. So when I get a signal from my aggregates, I'm not really answering your question, but the point is these aggregates are what we consider our best indicator, and any given indicator will give a bad signal at any given time. So that's why. But if you have, let's say, for example, you have 10 indicators that you think are usually reliable, and at any given time, one of those 10 or even two of those 10 might give you a bad signal, but you still have 80 of the others that are giving you the right message. So if you have a strong confirmation from your aggregate, you're probably going to be getting a pretty good signal. So, I wrote a long time ago. I wrote a publication. It's called "No Pets Allowed." In other words, we don't allow any pet indicators.
Nice.
Because what happens is, that if you have one indicator you really like, or maybe it's worked out well, and then you just have, for example, in 2007, everybody was talking about the Fed model, and what happened in early 2007, or actually early 2008, the market topped in 2007, early 2008. That signal, that indicator, that model, which basically comparing bond yields and earnings yields, essentially gave a really strong buy signal. A lot of people were saying, well, now the Bear Stearns bottom in the first quarter of 2008 was a buy signal. But as it turned out, our price-based indicators did not pick that up. And we had been underweight, we stayed underweight. And then, the market collapsed in the second half of the year. So, but had you just followed that one indicator, it would have been, you would have been on the wrong side. It would turn out to be a big decline. So that's why you want to always use a diversity of indicators.
Is that part of how you would explain the nuance of the weight of the evidence approach? Is that literally what that is that you're describing?
Absolutely. Yeah, that is the weight of the evidence approach, is that, you're going to go through periods when there's a lot of sort of inconsistency and mixed messages. And, like I said, right now I'm market weight, not very exciting, but the point is sometimes the market doesn't get into a decisive trend. And, like for example, right now we have the cap weighted indices that have been making record highs, and, but underneath the surface, the breadth has been pretty weak. So we don't have a consistent picture there. And that's what we want to try to understand. But there will be times when everything lines up. You get the breadth thrust, you get the major benchmarks moving, the weight of the evidence, and then your non-price factors are consistent. In other words, you got an easing cycle, you got policy support, you got the earning cycle is turning higher. And a lot of this was happening in 2022, 2023. We were at the end of what had been a big decline, and the earning cycle turned, the economic cycle turned, the policy cycle turned, and then the stock market broadened out. And it was a very clear picture at that time that this market, and then you still had a lot of skepticism. I mean, people were, pushing back in 2023 saying, this is not a bull market. This is a bear market rally. We're going to go back and make new lows. Well, as it turned out, the market kept on going. It's often said markets climb a wall of worry, which they did. And it was a pretty good market, until we got into this year. But that's kind of how we apply that weight of the evidence approach.
Let me see if I can kind of weave this one together. It's about going back to like model accuracy a little bit, if that's the right definition. And let me give you like kind of two examples. I'm just curious how, like, sometimes when you're if you're building a portfolio of stocks, let's say you're holding 10 securities, you might only get 50 or 55% of those buys correct, meaning they appreciate from the buy price, but still have a good performing strategy. And I'm just curious, like when you look at your signals, do you find that there's, I guess, do you look at that accuracy, and is there a way to assess that? I'm also kind of thinking like timing strategies, like to some extent you could have like a trend following strategy or some type of timing approach, and maybe, it gets whipsawed, it gets it wrong a lot, but it really gets it right in the big bear market. So the accuracy of like a model like that would actually be very low, but it would really do its job well in the most important time. So I'm just wondering, those are two very different examples, but how you might I don't even know if there's a question in there, but I'm kind of making these points to see how you might respond.
Well, yeah, I mean, I think what you're getting at is that we need to understand like what the models are really going to be most useful for doing. Some models, and we have different indicators that will work better at picking up. In fact, even in our models, we have some indicators that only give signals for sell signals, and others will only give signals for buy signals. But in a broader way, yeah, we need to. It's kind of part of it is to trying to understand, well, what is it you're trying to accomplish? Is it that you're trying to is it trying to get out of a market that's rising, or do you really want to get in on the buy signal? Because the aspect we always find with the markets is that tops form much more slowly than bottoms. Bottoms, it's often said, fear is a stronger emotion than greed. So you're going to have much higher volatility at a market bottom. And that's why I go through that, because I talked earlier about the Rally Watch report that I have, which is designed to assess whether it's a sustainable rally. I also have a Bear Watch report. And what this one does is I can take some of the same indicators, but it's the opposite level. And they say when you get to this level, for example, 28.5 on the VIX, that's a sell signal. I have other indicators that say when the VIX reaches an extreme and falls, well, that's a buy signal. But the point is that report has indicators that have specific levels. Say these indicator levels tend to be followed by continued weakness. So that's one way we can get to that. And what sometimes makes it very confusing is what happened this year. We got a Bear Watch signal, and then we got a Rally Watch signal. So the question was, well, which is right? And I think it just speaks to kind of the uncertainty of the environment we've been in. But that's one way we do it, is to see if you get you can have the same kinds of indicators, but have a different objective, either to confirm an uptrend or confirm that a downtrend, and then use those separately together with the overall model, which is always telling you something.
Something I'm always fascinated by when I see the Ned Davis research charts floating around, and I see snippets from stuff like your reports coming around in these different watches. The historical analogs. Do you like them? Do you hate them? Are they useful? Do you love going, this looks like the secular bear that happened in the 70s and 80s versus this looks like the cyclical that? Is that useful, or is it not useful?
I think it is useful, but I think you have to be careful with that, because there's no to. I often say the market is sort of like it's sort of like a spiral staircase. It's not entirely cyclical, right? In other words, things don't repeat, completely. You're not going to say, oh, this is exactly like this period. There's always some other element that comes into the picture. If the markets evolve over time, so there's no way you can completely say this is exactly like some period in the past. So I think you can look for similarities that can help in the overall scenario. And like we do, studies like this, well, after you haven't had, like one thing that's, we've been looking into recently, if you haven't had the Fed do anything and they've been on pause for one period of time, and then you get a rate cut, what happens to the market, what happens to bonds, and so on. But so those are kind of evaluations we can do. But I'm kind of reluctant to go too much. For example, all these secular trends I was talking about, the tops were very different. The drivers of the secular bears were different. The 60s, I told it was a nifty 50 era, and it was about inflation. The 2000s was a dot-com bubble, and then it was more about deflation. So it's a different backdrop, but there are similarities, and it does help to look at that. So.
I think part of what's interesting hearing you even talk through it is when you're using weight of the evidence across these multiple models, you can actually parse that nuance. And that probably allows to a greater amount of distrust from the historical narrative from the way you see the evidence in the models. Is that a good way to look at it?
Yeah, I maybe explain that a little more. You're saying that if you, maybe the way I would apply it too is that I think I talked earlier about correlations. And relationships change in markets, and they can change in one way and they change again. So again, with the bond yield stock price correlation, when we were in the 1970s, it was runaway inflation. That was the whole problem with the markets and problem with earnings expectations. And then yields turned around, but the market's still remembering, what was happening over the last 5-10 years. And so every time bond yields would go up, the stock market went down, the yields were still pretty high. By the time we get to 2000, the bond yield finally got below 5%. We get below 5%, deflation enters the picture, and the relationship completely changes. And it stays that way until 2022. So that's why I'm always looking at is correlations and understanding that, there might be this relationship now, but these things can change over time. And for example, I like to look for the more stable correlations, like the inverse correlation between the dollar and gold. And what helps with that is that if gold is going up and the dollar goes sideways, then you ask the question, so what's going to break? Is gold going to go, is the dollar going to go up and gold go down, or is it going to go the other way? So I think that's be one way of thinking about that.
Tim, let me ask you, Ned Davis Research has been in business since 1980. The firm has been through many bear markets. So obviously when we go through those, just like with asset managers, I'm sure your business sort of takes a hit. Although if you're adding value and getting the calls right, maybe you actually gain business in bear markets. I don't know. But the question I want to ask is, like, what in your mind, I mean, that's a multi-decade, successful company. And, you've been there not since the very beginning, but almost since the beginning. And what in your mind, just in the culture, in the company, has made it successful and been able to be around all these years and through these many market environments? Like, if you were to try to put your finger on that, what would you say?
I think it's the process of providing objective information that's reliable and time tested, and is not based on forecasting, or it's not based on some narrative. It's based on what's actually happening in the market and actually happening across markets, and how they all relate to each other, how the data relates to the markets. And I think it's that objective assessment that clients have found useful over the years. And it's not that, I mean, it's pretty much, I think there aren't I don't know anybody who does it the way we do it. So it's kind of a unique approach that people find useful as another, as an overlay against whatever they're thinking, or as another source of information to offset whatever else they're looking at. Because, we know our clients look at a lot of things, and, they're not just looking at our stuff, but they find us to be a useful addition to their arsenal when they try to figure out what's going on in the markets.
Yeah, and like we were talking about before we started the podcast, it's like you guys are based in Florida. That's where the company was founded, very far from the Wall Street, where the groupthink and, the S&P 500 target forecasts are made every year by the big investment banks. I mean, you guys are kind of doing your own thing independently down there.
That's right. We're independence actually is another aspect that people have always found they've always liked about our product, is that we are independent. We're just trying to get things right. We don't have an objective, or we're not trying to sell anything. We're just trying to, other than our research, but we're not trying to sell a point of view or sell anything else. But just try to understand what the markets are doing. That's our objective. So,
yeah. All right. So we have two standard closing questions for you. These aren't gotcha questions. These are supposed to be trying to get at things that you find important, or maybe where you might think differently than others. So the first one is, what is one thing you believe about investing that the majority of your peers would disagree with you with?
Well, I would kind of get back what I was just talking about, is that you really can't forecast the market. And I think people would disagree with that, but there have been so many times when we have expectations, and clients want to know what we think is going to happen, but we're not going to allocate based on that. We're not going to take a position based on that. So I think it's the idea you can forecast the market. It's not. We don't think you can, and we don't try to put out forecasts. We don't, say that like you said earlier, the S&P is going to this level. We don't do that kind of forecasting. And that, I think a benefit of that is that if you, I remember way back, I think it was 1987 or 88, somewhere in there, and there was a presentation, and Ned Davis, the founder of the company, came out, and he was wearing a green tie, and he gave a really bullish presentation. And they say, oh, I brought the wrong tie. He goes back, changes ties, puts on a red tie, and gave a bearish presentation. So the point is, you can really make any case you want, and especially when you have as much data and indicators as we have to support any argument you want to make. And so the danger of that is that if you have a view and you really want to support it, you will, but you'll end up on the wrong side of a major move and you end up losing money. So that would be my answer to the question, just that you can't forecast.
Before I ask you the final question, do you have a good crash of 87 story? You got anything good?
Well, yeah, I mean, that was, I was actually, my office was right next to Ned's office, and we had, at the time, this machine that would, when there was a percent move in the market, it would beep. It was like beeping all day, like ringing all day. I don't know what it's called, but it was, something big was going on, right? But, I think the thing about 87 was, we had signs that, we saw the indicator started to deteriorate, and, we didn't know it was going to be as extreme as it got. But it was also, one point Ned made at the time was that this was not a bear market that's anticipating a recession. So as a result of that, we could look at our indicators and see, well, if it's not anticipating a recession, but you've had this big decline, and it's really more about sentiment, then we follow the normal process. What happens, you get a selling climax, the market deteriorates, then you get a snapback rally, which we had after the crash. And then the market came back down in December. And, when you get that kind of retest with less downside momentum, you're starting to build a base, and the economic data was holding up. And then the market came back and made rebounded to a secondary high, and we were back into a bull market. So that was I was relatively new to the company at that time, so it certainly was a wake-up call to know the market could go down as much as it did, so in such a short amount of time.
And that you had a process for thinking through it too, because you started mid-'80s. When did you start there?
Yeah, I was at 86. So I had started about a year and a half before the crash. So
it's important that we still tell and talk through these stories, including the beeping, because that's something that, very few can relate to today in that way, right?
Yeah, well, even when we use the term, don't fight the tape, what is the tape? Yeah, I mean, there was a ticker tape back then. There's no tape anymore. So, but the term lives on, so we still use it.
The terms live on, including that floppy disk logo that I'm going to click save on after we get done with this in a second. One more question for you. Based on your experience in markets, if you could teach one lesson to the average investor, what would it be?
Well, it would be to try to stay flexible and don't get too caught up in your expectations, and understand the study history, understand relationships, but also understand how they change, how correlations change. And what the bond market's doing today might have different implications than what it was doing 10 years ago, when there was a different macro environment. So, but I'd say the main thing is just try to stay flexible, and, don't get too caught up in a viewpoint that's going to prevent you from being flexible and getting out of, I think it's just going to make you lose a lot of money very quickly, and that's not what we want to do in this business. So that'd be probably my main takeaway.
Here's to not losing money very quickly. Tim, if people want to follow you online, get some of these research reports, where should they look you up on the internet?
Go to ndr.com. That's a good starting point. It's our website, and we have we have the public site, and then I use the ndr.com every day for most of the day. It's a really good website. Get all kinds of information from it. All of what our indicators and models are doing. But I think if you wanted more information, I'd probably say start with ndr.com.
Fantastic. Tim Hayes, thanks so much for coming on Excess Returns.
All right. Thanks for having me on.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.